Hi, this is Shashank Mehta. I'm the founder of Equity Math, a wealth firm based out of Mumbai. If you've ever wondered how a global quantitative trading works, or ever wondered how you deploy quantitative mathematical models to make money across asset classes, across geographies, then we have the right asset manager with us here today. We have here today with us Mr. Ajay Kumar Vijay, who is the co-founder of 26 Miles Capital. Mr. Ajay has 2 decades of experience in quantitative trading. In his previous stint before starting 26 Miles Capital, for 8 years, he was a global portfolio manager in Quad-I, looking at a global quant portfolio. Prior to that, he was heading the intraday proprietary trading operations at Edelweiss. Mr. Ajay is a IIM Calcutta pass out and done his computer science engineering from MNIT Jaipur. Thank you for this opportunity, and I hope after today's conversation and this interview, our end clients and potential investors get an opportunity to understand why giving allocation to a quantitative trading strategy will help them improve their portfolio returns over the long term. Let me also make it clear here that an asset manager who is into quantitative trading, his mandate is to generate absolute returns versus an asset manager on the long only side, where the mandate is to beat the benchmark. With that, let me move on to the question, sir.
Sure, Shashank bhai. Let's have a friendly conversation about markets, about opportunities, and where exactly we fit in this overall architecture of financial markets, which is quite complex now, as you all know. Let's love to share our thoughts and let's love to share all learnings about this complex architecture of financial markets.
If you could give us a glimpse of your journey, your history of 2 decades, and Ajay Kumar's journey, and a glimpse on also how 26 Miles Capital came into being. Essentially, what is it that you were aiming for? What is the gap that you observed in the market that you believe the value proposition that 26 Miles Capital offers to investors? If you could talk on this.
See, my journey is like I think typical for all kids at my age. I think back in 2007, 2006, the typical blueprint for a middle class people to go up the ladder was go to good colleges, study hard, find a good job, and just keep growing with that job. I think that was a typical blueprint for like the entire Indian middle class at that time. I was part of the same. But what happened differently for me was in my second semester at IIM Calcutta. I was introduced to markets for the first time, and when it was like a case of, I will say, I'm not supposed to say that, but I'll say that it was like love at first sight for me. I got deeply in love with markets. It's just mixed of everything that I loved in my life till that time. It was finance, it was economics, it was a lot of maths, it was a lot of game theory, it was a lot of puzzles, and I just loved it straight away. And I just pursued that path till now. I think it's almost now 19 years for me that I've been in love with this market. Still, I'm, and I hope I keep doing it till I'm in my senses. Uh, so, uh, so it's just sometimes things happens for you in serendipity. Uh, it was not like IIM Calcutta was my first MBA college choice, but I got there, and it's supposedly be very good in finance. So a lot of teachers, a lot of professors were very good in finance. Once I found my interest, I was able to study good financial subjects there. I got deep into derivatives. I got deep into portfolio management theories, what is efficient market theory, how you can build portfolios, reduce risk. That was like ingrained to me at a very young age in my college days, and that still exists with me. That how you can maximize returns by while minimizing risk. So, anyways, when I was in the campus, I was quite lucky to get an internship in a trading firm where I spent 2 months. It was like one of the best 2 months of my life. I thought this is the best company in the world. I just loved it. The people, the culture, the job that I was doing, trading in and out of the market. I just loved it. I thought this is my future. This is what I want to do. And then Edelweiss happened. I got a campus opportunity from Edelweiss to join doing full time. I was hired by Nitin Jain, still my mentor. Uh, and when I joined Edelweiss floor, again I got mesmerized. A floor of 200 people passionate about markets, talking about markets, trading markets, you're living, breathing markets morning to night. uh, and just like my love for markets was kept increasing. I was fueled by the good culture, good people, passionate people, and it just got fueled inside me. Like I just got madder and madder about market. Right, started working on Sundays as well. I was a bachelor, nothing to do. Kept working on 7 days a week, and just kept trying new things. And it's just at that time the entire NSE got into algos, co-locations, TBT feeds, and then even Indian entire market microstructure was evolving on the technology side. And since I was a computer science background before my MBA, so Edelweiss chosen me. Okay, you take care of this piece for us. We believe that with changing technology at the exchange level, lot of manual trading might not be good for us. So we might need to go into automated trading as well. And that's how my journey happened. It was obviously uh, more to do with my seniors or my leaders at Edelweiss. Their focus was that this is the future of India and you should get into it. And I loved programming during my engineering days. So I thought it's again better for me, right? I'm mixing my finance and mixing my programming. So I felt it's good fit for me. So I went ahead with whatever happening in the market. It's just you're just rolling along. You are not planning anything. You are not like, okay, I want to go into quant or I want to do an algo. You're just going with the flow, right? Things are changing. The technology is happening in the market every year. The data that been collected at the exchange level, the data being collected at different sources to do research in the market was like multiplying like 10 times every year. And it's just a journey. Like it was just you're learning along the curve. There was no one to teach you because even if Edelweiss it was all new. But it was a very good time. We had lovely 7 years of my life there. I love the city. I love the place. I love uh, the entire culture of it, right? Where you actually being an employee, but you work like an entrepreneur. Every day you feel like you're an entrepreneur yourself. And then I moved to so once I got into that rabbit hole, right, I just got so much intrigued with the technology that I wanted to know more about technology. And Edelweiss being a very listed, high quality firm, very reputable firm, right? There's certain known go for them, right? Because at that time, some of the things that happening in the technology space was overriding the risk principles that a lot of reputed firms don't want to get into. But my curiosity was so high on the technology side, and I heard about this firm called Quadai based out of Gurgaon. They're doing amazing work. They like probably was one of the best tech company of India. Being into so, let me say one more thing. Some of the best technologies in the world are actually discovered by financial firms only, because the amount of money involved in financial market, the amount of talent involved in financial markets, actually end up doing these things. So I was intrigued. So I joined them. They were, and again, I got mesmerized. So my journey has been so lucky, touch wood, that all the three places that I've worked in my life, while my internship, my first job, and my second job, they all are one of the best places to work. Amazing culture, amazing friendliness for employee. So like at my quad, I like to give you an example. Like if you go to office, they serve you a very high quality breakfast, high nutrition breakfast. They serve you juices, they serve you coffee, they serve you lunch, snacks, fruits, dinner, everything. They just want you to just focus on your work and don't worry about anything else. Don't eat anything junk, don't eat anything unhealthy. Keep your mind sharp. And if you think your employer is thinking like that, he's taking care of your health as well, he's taking care of your bandwidth as well, that your bandwidth goes into the place you love, right? I mean, again, another 4 or 5 years of amazing journey there. But eventually, I felt that I want to build something of my own. There was a deep, I will say, itch inside me that I want to build something. And so 26 miles happened just like without much, I'll say, vision behind it. I'll be very honest with you. It's just like I wanted to build something in this space, and I was not thinking too much about what I want to do. I just wanted to be not an employee anymore and want to be an entrepreneur. So I just continued doing what I was doing.
It was natural progression.
Yeah, I was just continue doing what I was doing as an employee only, quant trading, algo trading, learning about technology, learning about data, keep doing the same thing, managing money for people. So once I got out of the job, lucky for me, we got a lot of institutional mandate that okay, we know that you are now not longer working anymore. Why don't you use your technology or your research to manage your money? But obviously, we took a pause of a year. We thought we first spend a lot of time in getting our technology up and right before taking anybody's money. So we took a pause of a year, built all our infrastructure first, and then we started taking care of institutional mandates. And even at that time, for us, for I think for the matter, we onboarded our first client, and after that we registered the company. So there was not thought of like making a corporate, making a vision statement, making a website, or even registering a company. It was just do something of our own, just build something in this space, and we'll figure out what we exactly want to build, right? So there was not thought process that we want to build a brand or something. We just wanted to serve people. We wanted to provide good quality products in the market. And luckily, our first clients were some of the best institutions that you can name for in India. And for them, and a couple of them are globally as well. And once we just kept building, we kept spending in infrastructure, we kept building a lot of data warehouses, we kept hiring the smartest talent in India, keep building pattern models in India. And at that time, like I felt something is off. I felt that this entire narrative of just putting a lot of money just because India GDP will grow. A lot of narratives happening where people I can see leaving job and putting their full-time money into just investing into stocks, assuming that this is the stream of income. Yeah, we are in a mother of bull run. We've been last 11, 12 years, or maybe I think more than 12 years, we are into a bull run. But investing is not income generation. Investing is basically from a perspective of preserving your wealth or growing your wealth, but it's not an income stream. And there I felt that there has to be better investment products out there in India. I think in the name of investment, people are taking too much risk. And that's why we felt around, let's build an organization around it, let's build a brand around it, and let's serve a wider community of people through our products. And that's where this happens. And so now we are more keen to work with a much wider audience of investors, take leverage of the technology or infrastructure or the knowledge that we have built in our company.
Great. So for our end clients slash investors, I think while long only would give you capital appreciation, but if you are looking for alternates where the end goal is to also get cash inflows to clients, then in that case, suitable alternate will be 26 Miles Capital, which is a global quant trading firm. Sir, moving on, especially for our investors who are new to giving allocation to an asset manager who's into global quant trading, would you help us understand what does a global quantitative trading fund do, and why does it have to be global in nature? What is the importance of being, having global exposure, and also peculiarities where we could point out how is it different from a conventional long only asset manager? If you could elaborate on this.
Sure. See, maybe I'll try to piece this into different components and try to answer it.
Sure.
Right? Let me go back to the core part of it, right? What exactly is quant trading, right? See, in quant trading, what we try to do is to basically try to find recurring patterns in the market. And to do that, right, you need to build technologies who can process petabytes of data. So, give you an example, petabyte means 1000 terabyte. 1 terabyte means 1000 gigabytes, right? So, that kind of size of data at which we try to build our machine to do research, to find pattern in the market. So, it's crazy amount of data. You're building technology where you can process that data and find some pattern in the market, which you believe have high probability to occur again in the market in the future. So once you build this kind of technology, right, it needs crazy amount of investment, crazy amount of efforts to build this kind of technology. So one of the best way to leverage whatever you're building is to make sure that you use the technology for multiple markets. So for us as a quant trading firm, the return from that capability building or return from the investment that we do to build this kind of capability can never come from single market. So that's why most of us have to be global, because the amount of money invested in this infrastructure is huge. To give you an example, right? Obviously, we are a very small firm now. We just started our roots in 2-3 years back. But some of the biggest firms, give you an example, they spend $500 million every year in their technology. I'm talking about trading firms. I'm not talking about technology firms. I'm talking about trading firms spending $500 million in a year on their technology. So that kind of investment goes behind building good quality quant engines. When you're doing that kind of investment, right, you need to make sure that it's scalable, it's repeatable, it can be used with multiple markets. So that's why for us to get recoup or investment back on the technology, we try to be trading multiple markets. So that's the core reason that a lot of quant firms prefer doing multiple markets. That's one part of the thing. Secondly, see what we believe, right? The opportunity. See, market moves in cycles. Right? We all know, right? Currently we are in a very crazy cycle in bullions, right? So let me say, give you an example. Like 1 year back, everybody was talking about Bitcoin is new gold, Bitcoin is new gold, Bitcoin is new gold, and actually it happened, right? Bitcoin become new gold. It's not moving at all. It's flat for a year. What gold used to do for, let's say, 8 years before that, right? And then gold has become Bitcoin. So they replace that. So market moves in cycle, right? You never know what will happen in which market will happen. Nobody will have predicted that what happened in gold and silver will have happened in gold and silver a year back, right? Nobody will have predicted like Indian market will underperform US market for almost 3 years now. Nobody will have predicted that, right? But it happened, right? These are things happen. Market moves in cycles, right? And it's some of the most difficult thing to do is predict these cycles. So what we try to do is build machine which we can run on multiple markets. And if any market is going in certain cycle, if any market where the activity is more, we try to make money more from that market. And maybe there's activity is less, we are under deployed in those markets. So this gives us capability. Since we anyways investing so much into technology to trade these markets, to process data of these markets, to make money out of these markets. So this gives us an opportunity to play these different cycles, right? You don't have to be dependent on one market or one particular set of stocks or particular set of instruments to make money, right? So that's how it works for us. It helps in us allocating risk better. It helps in capturing opportunities better. It helps in getting recoup on our investment. And you asked me like how to differentiate between traditional, right? See, what I'll say that, see, traditional investment is what, right? So I love Warren Buffett, right? What he says that when you invest in a company, you're actually buying that company, right? You're buying a company. Whether you buy 10% of that company or buy 20% of the company, but it's about buying a company, right? And when you buy a company, right, you buy a lot of things. You bought a house, you buy fruits, you buy groceries, right? Do you buy grocery at any random rate, or you buy them at an appropriate rate? Okay, this is the benchmark price. This is supposed to be the fair price. So in our thesis, tradition, like I'm just quoting some of the biggest expert on this topic, like Warren Buffett, right? What you buy is very important, but at what price you buy is very, very important. And we believe, right? So if you are investing in any particular market, right, irrespective of what happened in that country, or irrespective of who is the prime minister, or irrespective of whatever happened in that country, right? If you buy something good at a good price, it will give you return. There's no doubt about it. But if you buy something good at a bad price, it will not give you return. So investment need to be done from that mindset. It is not like you have to buy every day, or you think if you keep buying, you'll keep making money. To give you an example, Warren Buffett, Berkshire Hathaway is sitting on $350 billion of cash reserve. Why is he sitting on 350 million cash reserve? Because he believes that there's not right price. He doesn't believe there are not right companies. He said there's not right price. And if history teaches us anything, right price too comes in the market. So I think investing of late, what has become is chasing things. It's not chasing. It's just simple. Buy a right company at right price. And I think the right price part is being hidden in the market for some time now. And that's the reason last 18 months have been tougher for a lot of people, because right price is as much important as right security or right instrument. And that's where we believe an alternate is such a good part of anyone's portfolio, right? Because we try to play different cycles in different environment, different securities, different exchanges, right? We provide you the diversity plus the way we function, right? Or is more like an absolute mandate, right? So what we try to do is to find that smaller opportunities available in the market. We're not looking for one crazy long-term bet. Okay, I'm buying a company. I'm not buying a company. I'm finding a pattern and trading that pattern, making a small alpha, moving on, finding the next pattern, moving on, finding the next pattern. And there are days, smaller firms like us do more than 10,000 trades patterns in a day. And some of the bigger firms in the industry, they do what? 10 million to 20 million trades in a day.
Wow.
Right? So us is finding those smaller patterns. They are not looking for the right price, right stock. We are looking for smaller patterns. And that's where machine helps in doing that. It cannot do that as a manual guy. You can do it only through machines.
Okay. So I guess for our end clients / investors, the key difference, as Ajay explained, is about finding recurring patterns, going global, so that wherever these opportunities come, you could allocate more capital to that geography or to that asset class or to those set of instruments, and eventually ending up creating a machinery that the mandate for which the asset manager's mandate for which is to generate absolute return in shorter time frames of, let's say, 1 year, versus the mandate for long only asset managers, where the mandate is to beat the benchmark and generate returns over a period of time by owning good companies at the right, buying them at the right price and owning them for a longer duration. What is the core philosophy, or what's your thought process at 26 Miles Capital, behind how do you really end up making money for your investors? If I were to say philosophy behind the strategy.
As I mentioned, right, I've worked at some of the amazing places, right? And a lot of my belief or philosophy has been developed operating at those places, right? And primarily, there are only two components. You can put them multiple, but primarily there are only two components to it: talent and technology. It's just like the way we use talent in our business is much different than probably some of the other firms use talent in their ecosystem, right? So for us, we need some of the best talent, some of the best minds who can percept market, who can get better sense out of the data of the market. But instead of taking decision, so see, what do you believe? Human mind is much, much powerful than any AI tool still now. So we constantly compare all researchers' thought process with what AI can generate, right? We have subscriptions of all the things, like we go deep into all AI tools. What are their capabilities, right? Because we want to benchmark where they are. Human mind, I think we are still, in my opinion, a lot of time away where a machine or an AI tool can do what human mind can do, right? We have a unique sense of perceptions that we can build over a period of time that machine cannot do, right? But what we believe that human mind is not built to take a lot of decisions. Human mind is built to take crazy amount of cognitive load, crazy amount of analytics, crazy amount of finding patterns in a haze, right? But it's not good in taking decisions. So what we have done is in that our place, and what we have learned from the places that I've worked before is use human made talent to build machines. So that whatever knowledge base you have as individual, as company, everything goes inside your machine, right? And that machine take decisions. Because machines are much faster, much efficient, and they can check their decisions better as well. Let's say let's say there's a good intelligent trader out there who see most of the individual traders as well in their mind build systems to trade. It's not like they trade randomly. obviously they're not successful ones. The successful ones are the ones who have their systems inside their mind as well, but they've not written it somewhere, but it's there in their mind, right? But what we believe that load of decision making on your own system is very high. So the idea is so in a firm, right, we call it like in a trading machine. Everything that we built, we call it is a trading machine, right? And we all, whether it's a technology team, whether it's a research team, build together to build different components of this trading machine, right? If you see someday, I'll show you the architecture of a trading machine, and you'll find, okay, this is some good piece of work, right? Because there are multiple components, there are data pipes, then there are evaluation pipes, and there are allocation pipes, risk pipes, alpha hunting pipes. So a lot of pipes go inside that architecture. But you need talent to build this kind of complex machinery, which is a very beautiful machine, but a very complex machinery. Build this kind of machine, you need crazy amount of talent, and you need crazy amount of technology understanding to run this machine. Because to give you an example, right, we might be using what, maybe hundreds and hundreds of CPU cores to run this machine. It's not running on one CPU or two CPU or one server or two server, right? It's running on hundreds of cores developed on the cloud, right? We process, as I told you before, petabytes of data every day in our machines to find any pattern in the market. So you need talent, you need technology, and this, as a firm, we're crazy behind that. Give you another example, right? Most of the good quant firms out there, they, if you look at their expenses and their revenue, right, they give away close to 40 to 50% of their revenue as an expense to their talent. Another 25% on their technology, and just keep 25% as like profit to the company. Typical most quant firms around the world. I give you an example of some of the traditional fund houses in India, right? I'll not name them. I don't want to get into trouble. But we were just doing some research. 5% of their revenue, 5% of their revenue goes on talent. 3% of their expense, or I think less than 3% of their expense goes on technology. So with that kind of investment on your talent and your technology, you cannot build this kind of machine. You cannot capture this patterns that we capture in the market. So for us, we are in alternate space. We are not in traditional space where we try to find pattern where the market goes up, where the market goes down, where the market moves sideways. Our idea is to be positive every year, irrespective of what happens in the market, and to generate that kind of consistency, to generate that kind of returns. Only investment we do is on talent and technology.
Sir, could you give us a glimpse of what kind of talent do you hire? So, human capital with what kind of background, or generally, what is it that you look for when you say high quality talent? Or
See, India is a land of engineers, as you know that, right? And all of us, all quant firms, including us, we try to get the best engineers coming out of colleges. So, and I say this is where a lot of quant firms are similar in their nature. They all believe in hiring freshers, get them young, get them at the start of their career, so that they just get more accustomed to your kind of machine, and they do research, or they build products compatible to what kind of your vision is. So same for us, like us, we try to go to the best engineering colleges in India, try to hire the best talent in those colleges. There's one part that we as a firm try to focus little more on, is to avoid kids who are coming to markets for wrong reasons. See, markets by design, this is one of the places where the raw material is money and the finished product is also money. Right? There are a lot of places like making car, your raw material is metal, rubber, aluminium, and you make a car out of it, right? For us, it's raw material money, finished product is money. And what happens when there's so much money around you? For a young kid who's very young, he's coming from maybe a humble background, he say, "Oh, I need money. So this is the place to go." In our experience, what happens that when they come for the short-term reason, short-term urge to make a lot of money in this space, they don't understand the challenges go behind it as well, right? It's a very, very high stress place as well, because You are being judged every day. See, we are not, again, a traditional investment class where we're not playing longer cycles. We are trying to find pattern today. We are trying to find pattern tomorrow. So we are looking for those patterns. So we are playing with the market, interacting with the market on a daily basis. So it's a very high stress environment. So people who come for wrong reason sometimes don't survive that. But people who come for the right reason, who love this, who love these challenges, who love to play this game, who believes this is the right way to channel his talent, who comes with a certain competitive energy behind it, they do very well here. So that's one filter along the top of talent that we try to put in our kids so that they come for the right reason, they stay longer for here in this industry with us, so that they do well over a long period. They build long career here. They don't just come for a short-term burst. They build a long career, like what I have done myself, been in this for 19 years now.
Thank you, sir, for explaining the philosophy behind the strategy that you mentioned, which is essentially a combination of talent and technology. If you could help us give a walkthrough on the quantitative models that you build, what really goes into building these models, what kind of data is used, how often are these models reviewed, and once you make them or review them, how do you validate them? Like, how does it all really work? Because what I understand is ultimately it is this quantitative models that do the money making.
So let me, maybe the best way to answer this is to give you a couple of examples of what goes behind the scene, right? So see, as I told you before, right, I'm a passionate trader turned into a quant researcher to a quant portfolio manager, right? My journey happened that way. So I was always intrigued with chart when I was studying my trading career. I love looking at charts. I love to find patterns on those charts, right? And eventually, when I moved to the quant side of things or algo side of things, uh, I always thought, like, how can this can be done in a mathematical way, right? Because when you typically look at chart, right, different market, different instruments, normally people say different kind of chart pattern works, different kind of time duration works, right? There are thousands of chart patterns, there are thousands of trading universes in the world. How to do that if you want to do it through a machine? So that was a challenge which I presented to one of my researchers, right? And the way we approach the problem, right? He said, sir, I don't care about 100, 200, 1,000 or 1 lakh chart patterns, right? Let machine do that. So what we did is we would use machine learning. So this is where we say, I want to add one thing. Machine learning is very critical to financial markets. AI is not. So still there's no penetration of AI in market, but machine learning is quite prevalent in what we do. So one of our researcher used machine learning and he literally built a library of more than 1 lakh chart patterns. So now we have a library where we built 1 lakh chart patterns, right, across time durations. Now what we'll do, we'll run thousands of instruments on those chart patterns, and now the machine in its own robustness or in its own adaptive way will figure out what kind of chart patterns are fit for what kind of markets, what kind of instruments, and what kind of prediction power they have. So everything is assigned in this, right? This chart pattern happened on this instrument. This is the probability of this happening next. So everything boils down to probability only, right? So we have built this exhaustive library of chart patterns. We given input of thousands of instruments to it, and we calculated the probabilities of what will happen. And then we use a lot of libraries which are available to us to then cluster some chart patterns. Okay, these are the chart patterns which are relevant for this instrument. These are the chart patterns which are relevant for this instrument, and this all happens on probability basis, right? And then the final engine happens, which they said, okay, on this kind of probability, which will take trade at this allocation with this kind of stop loss or this kind of risk money on the table. And that's the final layer of us, which will decide, okay, this risk, this allocation for this kind of probability. And we build this entire ecosystem. So now we are not, see, when I used to do chart pattern, there's always some bias, right? Whenever I try to, let's say I'm looking at chart of Nifty, normally if I'm biased, bullish in my mind, I look to find some kind of long trigger in the chart, right? Chart patterns historically used by people like that only. They have bias in mind, they look for the trigger in the chart. But when we do it through machine, there's no bias. The machine will find the bias, the machine will find the trigger, the machine will find the risk, the machine will find the allocation. everything will be done by machine. And when you say about robustness, right, validations, right? So we don't, if that entire ecosystem was probably running on one instrument or two instrument or three instrument, we'll have rejected it. We only run ecosystems which can work on variety of instruments. So if this ecosystem that we build for chart patterns, if that can work on thousands of instruments, then it will go into our production. Otherwise, it will never go into our production because it's working on few symbols. You can always optimize it for some less number of instruments. We don't do that. Curve fitting is very high when you have a smaller trading universe. So we try to build robust systems which work on wider range of, again, that's where being global helps, right? You have data of so many exchanges. So some ecosystem that you built that working on a wide range of universe, and that's how we validate our systems. This is, and a lot of time we do out of sample validations as well, but we believe the cross validation where something is working on a cross section of universe, that's a much bigger validation than what you can get out of. So that is one style of, like I just say, right, the research that we do, right, or then try to find pattern which we trade in the market. Then there's another set of patterns that we try to find in the market, right? See, market, we consume data in our strategies at like a nanosecond level. Again, just to give you one nanosecond, like 1000 nanosecond means 1 microsecond, 1000 microsecond means 1 millisecond, and 1000 millisecond means 1 second. So that kind of 10 to a minus 9. So we consume data in our strategies at a nanosecond level. And market at its core bare level, the orders that are coming to the market happening at a nanosecond level, right? Those are the actual architecture, right? Eventually, everything is demand and supply, right? Everything is demand and supply. At what price demand comes, at what price demand vanishes, and at what price supply comes, and what price supply vanishes, right? Everything is about that only. And so, observing that data, at what price the demand is coming, at what price demand is vanishing, at what price supply is coming, at what price supply is vanishing at a nanosecond level, again, across a wide variety of universe, across exchanges. This data, obviously, because there are only few firms who have the capability to ingest this data and process intelligence from this data, again, it gives you superior alpha, because even if I tell you that alpha, it's not like this cakewalk to build technology to use this alpha in your production, right? So this is another way for us to do research, find patterns, and keep executing thousands of trades in a day.
To summarize, what essentially building quantitative models is to use machines to identify patterns slash recurring patterns, and the data that goes into this is quantitative data and all the data that comes in live from the exchange: price, volume, open interest, order details, and the way Ajay ji explained, at nanosecond level, how the orders get filled and how they get consumed. Um, the machine tries to analyze all this and takes decisions across instruments, across geographies, across asset classes.
That's a very important piece, right? So if for any new researcher when we join us, right, this is the first thing that we try to tell them, right? If you build a model which is working on one instrument, it's not a research, it's a curve fitting exercise. You can always fit a curve when you use very minimum data points, right? So the research means finding an ecosystem which works on thousands of instruments. That's what research is, not fitting one symbol or one underline. So that's a very important piece of the way we train our researchers as well.
So, sir, for investors in India, what do you think should be the right asset allocation mix when an investor thinks of giving allocation to a fund such as yours, which is into global quantitative trading? What is the right percentage that he should think about? Also, if you could elaborate on what is the current landscape in India for alternates? What kind of alternates are available, and how does 26 Miles Capital position itself in the landscape of alternate space in India?
See, I think it's a very right question. I want to give. So there's no right answer to this. I will say that, but broadly speaking, I think alternate should have at least 30-35% of anybody's portfolio. So what we do, see, let me see this. Roughly, you can divide market into two broad buckets, right? Traditional investment class and alternate investment class. We broadly, what we do, all absolute returns or credit funds or startup funds comes into alternate place, and rest all comes in traditional investment markets, right? Public markets and sometimes late stage private markets as well, right? So what we believe, the alternate as a category should be at least 30-35% minimum of anybody's portfolio. Can be more, but it should be minimum 30-35%. More so in the current market, because if you look at the current market, right, I think there's a lot of narrative in the market where they say that India GDP will grow at a certain pace, let's say 9 to 10% pace. So the market will definitely move up, or Indian market cap will definitely move up. Right? There's a certain kind of narrative that's happening in the market. My only point on that narrative is, if I give you an example from 2007 to 2026, China nominal GDP growth was closer to 10%. Closer to 10% on a
2017?
2007.
2007.
2007 to 2026.
26.
Yeah, China's nominal GDP growth rate is around 10%. It became from a 3 to 4 trillion economy to now I think closer to 20 trillion. From 3 to 4 trillion to 20 trillion economy. Right?
Okay.
That kind of growth China has seen, right? Crazy amount of upliftment in GDP per capita. And that's all in projecting, right? 2047, India will become very big economy, maybe 17-18 trillion. People are projecting that for India as well, right? And I am a firm believer that will happen. India will grow at 9 to 10% nominal GDP over a period of next 20 years. Even I believe in that. But to give you perspective, China market from 2007 to current is down 33%. In a 19-year period, point to point, in an environment where the economy grew a 10% nominal growth rate, the market is down by 30% or more than 30%. Because, as I mentioned before, it's not only about good quality company, it's about price. It's about price. 2007, China was crazy expensive. And next 19 years after that, we just proved that. And no kind of growth. And I give you another example, right? People say, people keep lose multiplier, GDP इतनी होती है तो market cap इतना होता है, some GDP market cap multiplier. उस पे भी I'll give you a point. In last 18 months, I think around 18 months, Nifty is closer to flat or slightly negative, right? India GDP has moved. Indian market cap also has moved. So Indian market cap is not flat. Indian market cap is up 15%, closer to what GDP has done. But Nifty is where it was. Because at a certain price, lot of fresh supply of equity comes in the market, right? A lot of IPOs are happening in the market. Last 18 months, I think it's close to 150 IPOs. I think closer to more than 2 lakh crore of money being taken out of the market through this issuance. Because most of them were offer for sale. They were not actually new money going to the company, right? 2 lakh crore of money taken out. So if you see that at a certain price, lot of supply comes. And that means market cap will keep moving because of this new issuance, because a lot of innovation will happen in private markets. When this GDP growth will happen, those companies will come to the public market, so market cap will go up, but your portfolio will not go up. So it's not the market cap went up by 15% means your portfolio went up by 15%. No, your portfolio might be negative. Market cap तो बढ़ गया. उसने आपको बोला था मैनेजर ने कि सर जीडीपी बढ़ेगी, बढ़ गई, मार्केट कैप बढ़ेगा, बढ़ गया, पर पोर्टफोलियो नहीं बढ़ा. बिकॉज पोर्टफोलियो तब बढ़ेगा जो कंपनी आपने बाय करी है वो आउट परफॉर्म करेगी. बट व्हेन कंपनीज grow this kind of growth rate that India is expecting or what China is expected, invariably what happens that lot of disruption happens. Lot of listed names, lot of previous large names, they stay where they are or sometimes become smaller and newer names comes. So give you another example. Citibank was the largest bank in the world in 2005. Citibank market cap today is lower than what it was in 2005 when US market, if I'm not wrong, is 6 to 7 times up from that level. Nobody knew the name of Nvidia, right? Last 5 years only. So Nvidia is now $4 trillion. So a lot of names that might add to Indian market cap are not even there. You might not even buy them. You're not buying them. So you're not buying them. Or what as we've seen a lot of times, especially in Indian markets, like a lot of companies come to listing when they max out their growth rates. They come, all their growth happens when they were private, and when their growth becomes slower, they become public, right? So you need to be very mindful of these things. It's not like GDP बढ़ गई और market cap भी बढ़ गया तो मेरा portfolio भी बढ़ेगा. वो सच नहीं. And especially that's the reason that we became available for a wider audience. We were making our money happily serving few institutional clients. It's easier, you're getting much larger check size, easier to manage them because you can always provide them customized services. But we felt deeply inside that this is not right. This is not right. An average investor in India who have sizable portfolios should have a lot of alternate exposures in their portfolio. And in alternates, broadly, market divides alternates into two parts. Low risk, high risk. Low risk are like people say, FD से थोड़ी सी ज़्यादा risk, FD से double से ज़्यादा return. That one kind of alternates, lot of offer market. Second is equity market से कम risk or equity market से ज़्यादा return. We broadly currently serving that segment. We want to serve this segment as well. But again, in alternates as well, there's one thing that again missing in Indian market, which is there in all developed markets, is liquid alternatives. A lot of alternative investments in India are very illiquid. They tell you to lock your money for 5 years. They put you in a closed-ended fund. We run an open-ended fund with weekly NAVs, weekly redemptions. Because we know that for any product, even for us, you need to have a patience, right? I'm not saying that or is a like quick money thing. Even for an investment who's investing in our fund, it needs time. It need to be patient. It need to might see a couple of drawdown cycles here as well, right? But we are liquid in the sense if you need money tomorrow, if you have some emergency, if you need money to buy a house or any other opportunity coming in front of you and you want to take care of that opportunity through your money, we will not say that, okay, sorry, we can't give you money. Or we'll only say that because you lost money because you took out money. That's not the game that we are trying to play. What the game we are trying to play is market is full of opportunity. If you build the right kind of technology, if you build the right kind of talent, you can keep finding those opportunities. Though there will be times when we lose money, but they will lesser and we will try to be more consistent. In my career, I've never seen a negative year. And there's crazy amount of investment we do every year in our research, in our data buying, in our technology build-up, that we should not have any negative year for our clients. Our clients should not become poorer what they were a year before. That's a very, very critical goal to our mission. And we want to make sure that a client can take out money anytime he wants. I'm not saying, obviously I want certain patience, but his patience should not be at the expense of he needs money and I'm telling him you cannot take it. So a lot of alternatives in India are illiquid. So we want to provide a liquid alternatives. Currently we are serving a lower risk than equity but higher return than equity segment. Tomorrow we will love to serve people who want much lower risk but returns higher than FD. We have product for that, but we'll take some time to launch them because we want to make sure that whatever experience we provide is a superior quality. And that's where we are building right now. And when you say that in terms of when anybody invests in our companies, it's very simple. We spend a lot of time, last 12 months have gone into making sure that we have the right pipeline. So if anyone invests, he can just get a dollar NAV. It's simple. You will get your returns in dollars. We'll take care of everything. Hong Kong जाना है पैसा या US जाना है पैसा, ब्राज़ील जाना है, यूरोप जाना है, इंडिया में आना है, कहीं भी इन्वेस्ट होना है आपका पैसा, कोई भी करेंसी की रिस्क आती है, किस भी तरीके से अपॉर्चुनिटी को ट्रैक करके पैसा कहीं ले आना है. We build a pipeline for that. Like we spend a lot of time in doing that as well, so that money moves seamlessly as per the opportunity or models or machines is seen in any market. You get a simple dollar NAV every week. You look at it. You feel it's in the right direction. It's what we promised you at the beginning of the journey. And we can try to keep it very simple. All the complexity at our level and just simple weekly dollar-based NAV for the investor. That's how we want to operate.
Thanks for explaining what is the landscape of alternates in India and what should ideally be allocation that an investor should give to a fund such as yours, which is into global quantitative trading. Could you also elaborate on how do you decide on the exposure that you take into different asset classes across markets? How do you do position sizing? And a follow on would be, how do you manage risk? Because conventionally, what investors understand risk management is by buying natural hedges to a underlying. If someone buys a certain position in a futures of an index or a stock, buying a put option is considered as risk management or hedging. Is that how you manage risk, or how do you really manage risk in a global quantitative trading fund when you take positions across instruments and asset classes across geographies?
See, you mentioned position sizing, exposure management, risk management. For us, everything is one single thing, right? For us, everything boils down to one thing, which is probability. See, everything that, see, our machine, the core on which the entire machine works is probability. It's constantly trying to calculate probability of certain event happening, market going up, market going down on the basis of some pattern. Right? So आप निकाल रहे हो कि क्या चांस है, 50% चांस है, 70% चांस है, 90% चांस है, कितना ऊपर जाने का चांस है, नीचे जाने का चांस है, नीचे पे कौन से लेवल पे जाने का चांस ज़्यादा है या कम है. So, or for us, our entire trading is built around these models, right? So for us, risk management is not a separate activity. Like, I like this stock, I'm buying this stock, now I'm buying a put option to hedge. It's not a separate action that we take for risk management, right? So let me give you the little bit of architecture, right? The way it happens, right? I told you about the data ingestion, right? हम data ingest करते हैं हमारे models में at a very high frequency, like nanoseconds. अभी data जाता है तो data transformation where सब ऐसे समझाओ कि डेटा को ऐसे फॉर्मेट में किया जाता है कि जिससे मशीन उस पर सिग्नल बनाता है, फिर मशीन चलती है और प्रोसेस रन्स और अल्फा मेकिंग मशीन रन्स which try to find whether what is the probability as per this data of something going up, something going down, right? Then our decision making framework decide, is this probability enough to take a trade? Okay. Then our allocation and risk management framework comes. It's a one path, right? It's not like one order goes and then risk management happens. No, it's one path on which every evaluation is happening. Then our allocation risk management layer defines, okay, this opportunity at this probability with this kind of environment, this kind of volatility in the environment, what should be the position sizing, what should be the stop loss of this trade, all pre-decided. Every trade that we do in the market goes with a stop loss in the market. There's no trade which are wild trades. Okay, we've taken it and we're sitting back. We're not buy and hold or sell and hold. We are probability made machines where we're calculating, okay, this is the chance of going up. This is the money I'm putting online. If this goes wrong, this is where I'll end my prediction, right? So this is one layer. There is no separate layers, right? Obviously, what we have done separately, because for us, the second layer of risk management that we do is on the technology side, right? Because everything is inside a technology box. So we have put a lot of risk checks on the top of technology as well. If technology fails, if some process fails, how we navigate that. So we have a lot of, what I'll say, loggers running, a lot of processes which are monitoring the health of entire machine, monitoring the health of our technology, right? Monitoring the health of any process that we are running, right? So for us, the risk management on the traditional risk management perspective of money making, money locking, money losing is part of the evaluation of one path only. It happens at the time of entry only. It doesn't come as an afterthought. It doesn't come as a separate action. And then the second layer of risk management, which is on the technology machine or technology architecture, we run a lot of process on the lines of that. And as a foolproof mechanism, we have a 24/7, 365 days monitoring people, monitoring our technology. They're not monitoring our trading, they're monitoring our technology. If anything which our technology fails and our backup technology not able to capture it, so there's a manual guy always looking at our processes health, whether all processes are up and running or not. So we make sure that we have a 7-member team They work in different shifts, but we have 24/7, 365 days a year monitoring team which take care of that. So that's so as a firm, from a risk management perspective, we spend more time on that. The traditional risk management, which is on the P&L side, is all part of a logic only. So another part of risk management is, let's say, any strategy which is not working, right? That's also inbuilt. If some strategies we have pattern making, so we are pattern finding firms. If we can't find pattern in our own strategy, okay, this strategy used to do this in this kind of market, it's underperforming now. So we have set that kind of allocation logic as well. If some strategies stop working, we constantly reduce allocation to zero as well. So everything is part of the research machine. So for us, whether it's strategy not working or any particular trade not working, everything is part of the one process only. It's not a separate part or separate layer. And another thing that we do, which is again our global architecture and being global and trading thousands of universe help us, is we put very minimal trade on the capital. Let's say if I'm managing X amount of capital, on any particular trade, the capital risk that we take is very minimal. So even in our drawdowns, so drawdown comes when thousands of trades go wrong. Like one trade or two trade can bring out drawdown. A drawdown typically comes when thousands of trades in a very short period of time go wrong for us. And that happens. It's not something that is like an outlier event. It happens like once a year, every time it happens that certain market condition happens and a good quantity of our trades go wrong and we lose money and we hit our drawdowns. But not any single trade can cause any drawdowns. The systems are so built that way that even at the entry time only, we make sure that the trade goes with the risk. The risk is very minimal.
Wow, it seems very intense and very comprehensive. And I also now understand how is it that risk management takes place. You also say that returns that a global quantitative trading firm generates are uncorrelated. Is that a byproduct of this risk management?
Very interesting question. Very, very interesting questions. I think you nailed it very right. The entire thesis of quantitative trading when it started years back was on this correlation aspect, that people wanted a product which is uncorrelated to the traditional investment products, because obviously what you do in traditional, as I told you, you buy businesses, right? And the idea is to put substantial capital behind a business, right? You want to buy as much percentage of that business. So it's a business where you want to put a lot of capital at risk in a single trade, right? And it goes through a cycle then, right? Even good companies go through all kinds of cycles. So the entire origin of alternatives or entire origin of quant basis alternatives is on the basis of this correlation only. So you got it right. Yes, this entire framework where you put very minimal trade on risk in a particular trade and you take a lot of trades to make your money is pretty much the key part of why whatever we do is not correlated to anything at all.
Okay. So what's important to know for our clients slash investors is that while Ajay ji has comprehensively answered how the fund manages risk, but it is essentially allocating very, very small portions of the capital to multiple trade ideas. And with these multiple trade ideas having predefined stop losses and targets, and the probability that they will hit their targets would eventually accumulate, or accumulation of that allows them to manage risk without taking natural hedges. So risk management is very central to what you do, and in your previous answer you explained it quite well, that for a fund such as yours to see a drawdown, thousands of trades have to go wrong in a very short period of time, and it does happen once in a while. If I were to move on and see the other side of it, and if we move on to how does performance happen in a fund such as yours, do thousands of trades have to go right for longer time frames? Is that how the fund performs? What are the real drivers of performance for a global quant trading fund such as yours?
Let me give you a brief idea about how typical a quant fund like ours works in terms of basic success and failure, right? See, on an average, for different quant number funds, its number is different. But what, as I told you, we take thousands of trades every day, right? Out of those trades, right, average on an average, the success of those trades is 55, 60. It's somewhere between 55 to 60%, different for different quant funds. For us, it's closer to 55 than 60. I'll be very honest. And then how much you make when you are successful and how much you lose when you are wrong. Right? So let's say if your 55% trades are successful, 45 are unsuccessful, how much you make in your successful trades? So on an average, we make 2.5 times in a successful trade as compared to what we lose in a loss-making trades. So this capability of putting very small amount of risk on every trade that we take, but if the opportunity presents itself, we ride our trades, we continue with our trades. So let's say what happens? Let me give you what days are our best days, right? Let's say market opened in the morning and we took a trade, certain probability happened and we took a long trade, right? And when this long trade probability happened, like let's say for the rest of the day, whatever patterns, that strategy, whatever patterns are coming, whatever data is coming, keep saying the probability is to keep long, and stay long in that entire day and capture a good amount of profit. Right? These are the days when we make a lot of money. When a big movement happened in a very short time period of time, and our models actually just rolled on that moment. You don't have to exit a trade, and you just continued with the trade only. So this asymmetry in our upside trades versus the downside trades, like we make 2.5 times in a winning trade versus what we do in a loss-making trades, and along with 55% success rate, these two combined together creates a very consistent return streams, which maybe a couple of times in a year loses consistency, but for the most part of the years, it shows big consistency. So this asymmetry where we make closer to 2.5 times in terms of what we lose in the loss-making trades, this along with a very reasonably high success rate of 55%, these two combined creates a very powerful, consistent money-making machine. And the idea is to keep working on making sure that our success rate improves or win to loss issue improves. The entire research or entire machine building at our end goes behind these things only to improve these two numbers so that we become more consistent, give higher returns to our client. And as I mentioned, right, there are phases where we get a very good run and we make a lot of money. So when I say consistent, it doesn't mean that it's like an FD, right? 0.5% interest every month. It doesn't work that way. That typically let me put more color to our performance, right? Not typically happens when we run all these things together, right? There will be 3 to 4 months in a year, which typically will be your annualized returns. There will be a couple of bad months, and then there will be other 6 months which will be flat to positive, which will cover for the 2 bad months losses, and those 4 months which will be high return, typically double-digit return months, which will be driving your annualized returns. Though we do behind the scenes a lot of work to bring consistency, even after that, it's as good as the opportunity presents in the market, right? So another thing that since we are such an active firm, right? We do thousands of trades every day. It means we pay a lot of exchange fees, we pay a lot of brokerage fees, we pay a lot of STDs. So we pay a lot of charges in our trades. So what happens when market is not doing anything, we are still entering and exiting, right? We are paying all these fees. So it's not like every month I'll make money without any opportunity present itself in the market. But what we try to achieve is to have good 4 or 5 months in a year instead of saying good 4 or 5 years in a 20-year cycle, or is like good 4 or 5 months in an annual cycle, and you have a couple of bad months. There's no denying about that part as well. Typically, it happens when there's a lack of opportunity and we're end up paying a lot of cost. Sometimes a drawdown triggered by our cost only, not even by bad performance or by negative P&L. It's just triggered by thousands of trades ending in flat, and we pay a lot of cost on those trades. So sometimes even drawdowns are triggered by that as well.
And And while you've very aptly explained that it is essentially the percentage of winning trades and the reward against every rupee of risk. So if the reward is 2.5 rupees for every rupee of risk, and if the percentage of winning trades are 55% or more, it would end up giving the performance that the fund can deliver. If we were to again drill down a bit deeper into what market conditions are more conducive for a fund such as yours to perform, is it a trending market like an uptrend or a downtrend market? Is it very high amount of volatility, or are stable markets more conducive? Are these the right drivers of your performance?
So what I'll say that, see, if I'm a true alternative fund, if I'm a true quant fund, right? See, so what typically a good quant firm take pride in itself, right? Good quant firm like us who try to aspire to be one of the best in this industry, what we aspire for is there should not be any one factor. There should not be any one factor which determine my returns. So let's say 2 years back, my India book was doing well when there was higher volatility and was doing bad when there's lower volatility. So what we do behind the scene? So in our research meetings, what we discuss, like, okay, guys, this is not acceptable. The market can stay lower for years and years, right? We can't do that. We cannot just go out and tell our clients that we lost money because market was lower. This is not how it will work. We are an absolute return fund. So whenever we see that there's any factor, so the way we work is if we find any factor on which our returns are dependent on, we through our research try to address that. So it's not like we're very comfortable and very proud and say, oh, we'll make money in volatile market and lose money lower. We don't feel pride in that. We don't want to be that kind of firm. For us, we should be agnostic of, when I say I'm agnostic about market going up and market going down, I should be agnostic about volatility. I should be agnostic. So there's one factor which is a little bit important is liquidity. And even in that, we are trying to address it by making sure that we trade all liquid markets across the world. So we keep adding our universe. So the idea for us is to trade every liquid market available in the world. So we focus on liquid markets only, and let's say theoretically all liquid markets in the world tomorrow become illiquid, right? Then a model like us who trades in and out actively, that's where the struggle might come, if you ask me. But that is part of the business. That's the businesses that we take. But we do believe that there are a lot of pockets which still not touched, because there's a lot of liquidity exists. So for us, it's very simple. As long as there's a liquidity in the market to enter and exit that trade, there's no other factor on which our return should depend on. So from a research perspective, we focus on that. Bring consistency.
And would it be fair to say that a combination of these two things, higher winning trades, better risk reward ratio, ability to trade any and every market, whether trending or volatile, a combination of these two gives you or your fund higher Sortino ratios, higher Sharpe ratios, and for our clients slash investors, it's important to know that a global quant trading firm such as 26 Miles Capital delivers a much higher Sharpe ratio or Sortino ratio, which is essentially the reward that you take on every rupee of risk. So, sir, does this convert into higher Sortino and Sharpe ratios?
Yes, you had them rightly pointed that. See, typically alternates, as I told you, the alternate industry only existed to provide uncorrelated, better risk-adjusted returns. So its focus was to provide high Sharpe ratio products where you provide superior risk-adjusted returns, uncorrelated to what is already available in the market, which was traditional long only. You do through ETF, you do mutual fund, you do PMS, you buy on your own, right? The traditional investment class. So the alternate industry, whether what we do or any other guy out there is doing, is to provide something uncorrelated and much better Sharpe ratio. See, though there's a serious amount of wealth creation happens when you buy good stock at good price, but even in that, even if you pick the bad stock and put it at the right price only, even in those scenarios, the best performing fund managers, let's say we today see who was the best guy in last 10 years, and assume we invested in that guy only. Even in after like hindsight wisdom, the Sharpe ratio you will get will be less than 0.5. So that industry exists for a different purpose. It doesn't exist to provide high Sharpe ratio returns. It exists to provide long-term wealth creation by buying good stocks, but at a much higher risk, at decent return, but much inferior risk adjusted returns, right? So, and obviously, when you are putting significant amount of money at risk on one particular investment or one particular style of investment, your risk reward ratios is supposed to be inferior only to something which is alternate to that, which is doing a much active alpha picking, uh, a lot more wider universe coverage, and trying to play up cycle, down cycle, high vol cycle, low vol cycle. So obviously, since we're combining all these things, it leads to a much improved Sharpe ratios. And as I told you right at the beginning of we spent a lot in our technology. We spent crazy on our talent so that they build this machine. They figure out these alphas which are available in the market, which are uncorrelated, provide superior risk-adjusted returns. So constant focus is to find that talent and keep building on technology.
Right. So ultimately,
lot of investment goes in that.
Right. So ultimately, this superior risk reward is a function of talented humans at work. So, sir, in your previous answer, you mentioned a very important point, or that you essentially look for liquidity, while you would be creating a strategy or a fund that is agnostic to other market conditions in terms of delivering performance. But liquidity is something that you would need. Is it the hunt of liquidity due to which your fund participates in global exchanges? And how many exchanges does the fund currently participate in today? Versus, do you have plans to increase that number of exchanges? And a follow on would be, does that have any impact on the Sharpe ratios and Sortino ratios in the long term?
See, you rightly pointed. We are a liquidity chasing fund. We look to add all liquid exchanges across the world to trade in. Currently, we are trading on 12 exchanges in our fund, and our idea is to keep adding, look for more liquid exchanges. See, for us, the idea is to make sure that every liquid instrument anywhere in the world, if it's moving, we should be trading it, we should be participating in it. And it's a kind of a challenge that we internally thrive on as well, right? Compete with big boys, right? Firms like Millennium, right? The big boys out there, like $80 billion guys. We want to compete with them. We started this being very humble. We are a very small firm, but that's the target at which we are running. Trade all liquid exchanges across the world. A lot of technology built up, a lot of data warehousing is happening as we speak. So we are already started warehousing or storing the data for 5 exchanges more, which you want to roll out in probably next 12 to 18 months. Let me see this, right? What is the function of Sharpe? Sharpe ratio ज़्यादा कैसे आता है? See, diversification का सही मतलब क्या है? Today, if let's say I'm a mutual fund guy, right? I have 20 stocks in my portfolio. Am I diversified? Will me owning 20 stocks of a same economy, same country, is it diversification? In my opinion, it's not. It's stock picking. You should buy it only if those stocks deserve any merit. But you should not buy more stocks, buy more mutual funds, or buy more schemes or more PMS for diversification, because they are underlying playing the same thing, right? If something happens which triggers a collapse, all of them will go down equally. Maybe one more, one less, but the correlation will be very high, right? Sharpe ratio happens higher when you do a lot of things which are uncorrelated, right? So if I add another exchange, let's say you, where I'm not operating right now, it will be completely uncorrelated to what I'm doing in India, what I'm doing in Hong Kong, what I'm doing in Brazil, or maybe what I'm doing in US. For the matter, even the market hours are different. So for me to, so like Hong Kong and Brazil have zero correlation in their market hours. Market hours ही अलग है. India, US, zero. Their market hours ही अलग है. So when you operate in this kind of completely uncorrelated environment, right, it automatically improves your Sharpe ratio. So in my opinion, if you are hunting for Sharpe ratio, what is the target for us? To hunt for AUM, to run a much larger AUM like big boys, like Millennium, to provide the same Sharpe ratio, maybe better Sharpe ratio than them. So that dream will only come when we as a firm first invest and then try to sell up. Keep investing in more exchanges, more infrastructure, more data sources, and keep improving our Sharpe ratio. And we believe, and this is something that we tell to our investors as well, right? Diversification आता ही तब है जब आप uncorrelated bets लेते हो. If आप correlated bet लेते हो, आप कितना भी diversify कर लो. If they are correlated, this is not diversification. This will not improve your Sharpe ratio. This should only be done if you think there are so many opportunities available to you. You should not do it for diversification.
Right. So for our clients/investors, the key takeaway is that Sharpe ratio improves when you diversify with uncorrelated instruments/underlying assets.
Yes.
Sir, a follow on is when you say you are currently trading 12 exchanges, tomorrow you want to trade any and every exchange out there which provides you liquidity. What does it really take to trade or connect with an exchange? Do you need a certain kind of low latency execution infrastructure? Do you need co-location? What is it that you need? What is the time taken to connect with an exchange, or what is the cost involved? How easy or difficult is all this?
It's tough. It's tough. See, it journey starts with we first buying data. See, for us, if in any exchange that we do, we first buy data of that exchange. And typically, most of these global exchanges, the frequency at which we buy like the granular data, like level 3 data, tick by tick data, second by second data. These cost us thousands of dollars, or I'll say hundred thousands of dollars to just buy data first. And once we buy the data, we put it in our research machine, in our research platform. We give it access to our researchers, and they try different alphas on them. Some which we are running similar to other markets, something which they believe might work more in this exchange because of its own microstructures. And once the research happens and we believe there's a certain merit in taking this exchange to a production environment, then parallelly my technology team, while the research models go for out of sample testing, our technology team start building a low latency infrastructure to connect to those exchanges so that in whatever data we consume in our bed testing, which is like a nanosecond data, we can get the research models or our production models get the same data. Typically, this entire cycle in some exchanges cost us at times $1 million as well.
Wow.
To just add an exchange. But we believe that it's a worth it investment because over a period of 10 years, 20 years, this exchanges that we are adding can give us much higher returns and gives much better Sharpe ratio or consistent return to our investors. And on another line, what we truly believe is we want to be an Indian origin run by Indian guys, but playing global game. And we want to make sure that we give our Indian investors access to this global game as well, where they feel proud, okay, my money is operating not only on Indian exchange, my money is operating on hundreds of exchanges. And any opportunity existing in hundreds of exchanges, this is the fund which will help me capture that. And obviously it's expensive, obviously it's take a lot from our balance sheet, but we are in this to build for long term. We are in this build to something which can challenge, or for the matter, if you ask me, right, Millennium today runs an $80 billion fund. I don't think even 0.001% of that is from Indian investors, right? It's probably one of the best Sharpe ratio fund out there, right? Some of the Indians are not getting access to these funds. And we think Gift City, the initiative taken by central government to set up Gift City will change that. The talent available in India will change that. And we believe there's a crazy ride in front of us. A lot of AUM, a lot of demand, but a lot of complexity and a lot of hard work at our level as well. But we want to get there. We want to get there to 100 exchanges, provide so many Indian investors sitting in India or maybe sitting outside India access to these exchanges. At the firm level, at the company level, believe this gives us competitive moat as well. Tomorrow someone wants to copy us. It's not easy because 100 exchanges is not easy for anyone to copy and emulate. So it's a tough journey, but we are in this to do that.
I think the key takeaway for our clients/investors is firstly, I think we need to thank SEBI, IFSC, and the Indian government for setting up Gift City and for allowing asset managers like 26 Miles Capital to roll out AIF, which are based out of Gift City, which are essentially dollar denominated vehicles, where essentially it has allowed to democratize opportunities to trade globally, which were otherwise available only to, let's say, ultra high net worth individuals or institutions or family offices through this vehicle. And because of asset managers like 26 Miles Capital, we've been able to democratize it to even individuals who can invest with a minimum ticket size of $150,000 US. Sir, for our investors and clients who onboard with us, what is the mindset that they should have? What is the temperament that they should build during a certain drawdown or during times of underperformance? What is the right profile of investors, especially when they build a mindset to give a one-third allocation of their wealth to global quant trading firm such as yours? What is the right temperament to have?
I think any investor can say it's whatever we do, it's not that complicated, I think. So I think what is missing is, since this product is not a very popular product, it's not quite educated product. So I think the onus should be on us, you, me, to make sure that we educate people on this, because it just needs little bit of understanding. And I think anybody can invest in these kind of products. They are, in my opinion, doesn't put too much pressure on you in terms of large drawdowns. But that couple of things that we have struggled in the past when we try to talk to. That's why we always prefer to work with institutions, because it's easy explainability for them. But the couple of struggle points for us in the past have been two. One is, as I told you in the beginning of the conversation as well, there are typically two kinds of alternatives. One, which are FD plus plus, we call them, like risk slightly higher than FD, 2-3% risk as compared to zero risk in FD, but providing 2x return of FD. And the ones which are slightly lesser risky than equity, like if equities standard deviations are 14%, 15%, they'll give you 8-9% standard deviation, but give you maybe higher returns than equity. Right? What happens that when people come to quant, especially quant part of alternative, they believe, sometimes they believe it's some magic, like we are doing some magic thing and we'll provide this risk, the FD risk of 2%, the equity plus plus returns. So these are two separate products, but what they'll do is they'll take risk from here and they take return from here and they say, this is the product I want. Which sometimes what happens, some people promise them as well, right? But that never happens. See, one thing which is, you being a veteran yourself in market side, there's no free lunch. There can be better product or worse product, but there's nothing free. There's no way of making higher returns without taking higher risk. It doesn't happen. It never worked, never happened, will never happen, right? There's always an element of risk. So this confusion sometimes create a lot of issues for us. People come to us expecting this return, but this risk. And though we explain them that we are operating at these risk return levels, but they assume something different. They're not listening. They assume something different. And then they struggle. Okay, we thought this is free, this is safe. How can if I'm promising you 25-30% returns, how can it be safe? See, there's no way I'm providing 25-30% return without taking risk. It's not even possible, right? So this is one challenge sometimes we face, that these are two separate products. This is 10-12% return for 2-3% risk. This is 25-30% return with 7-8% risk. These are two separate products, need to be looked at separately and see which fits your profile and consume accordingly. That is one challenge we face. Second challenge that we face, and that happens even with our institution guys, is that whenever drawdown happens, see, the way we build a machine, right, it's so many components to it, right? So many exchanges, so many instruments, so many strategies, so many alpha, so much of risk layer, allocation layer, right? It's not possible for me as well to predict when the drawdown will come, all right, and why the drawdown will come, right? So what happens when your drawdown happens? The explainability of drawdowns in a quant fund like us is much lower than let's say in a traditional investment class. If कोविड में पूरा मार्केट 40% गिर गया और आपका पोर्टफोलियो भी 40% गिर गया, तो आप जाके अपने फंड मैनेजर से ये नहीं पूछोगे कि मेरा 40% क्यों गिरा. आप बोलोगे भाई समझ में आता है मेरे को, निफ्टी आधा हो गया, मेरा पोर्टफोलियो 40% है, ये आपको समझ में आ जाएगा. आपको एक्चुअली फंड मैनेजर से मिलने की भी जरूरत नहीं है ये समझने के लिए कि 40% का drawdown तो बड़ा होता है. But फिर भी you don't need a meeting with fund manager to get an explanation कि भाई मेरा drawdown क्यों आया, because you understand that intuitively. In our business, if I promise someone 7-8% drawdown and I say 6% का drawdown भी अगर आता है, so explainability for us also is very low. They ask me क्यों आया, and a lot of times even we don't can only thing we can say कि thousands of trades went wrong. There's no other explainability. There's no other factor on which I can put blame for this. It's not end of the quant world. It has happened in the past. It will happen in the future. It's not like my models are suddenly underperforming, because what happens that in that brief 2 months, you feel this machine is stupid. It's taking all kinds of, because thousands of trades have gone wrong, right? So you say, अरे यार 1000 बेवकूफ ट्रेड ले लिए, कितनी बुद्धू मशीन है, 1000 ट्रेड गलत ले ली, right? Well, it looks very foolish from outside. Whenever drawdown happens, it looks very foolish from outside, and it becomes very, very difficult for us to explain to our investors the way machine is being built. There's a lot of things goes behind the scene, and it's very difficult even for us to give a right kind of explanation. It's just this sense returns are absolute, where we don't explain कि भाई market ऊपर गया इसलिए मैंने पैसे कमाया, नीचे गया तब मैंने पैसे कमाया. We made money absolute, or risk is also absolute. There's not explainability behind it. And someone who understands that and still goes ahead with us is a very important part. That कि drawdown जब आएगा तब there's no like I can do a 3-hour call and explain in कि क्यों आया. I will only say what happened. Like, these many trades gone wrong. There's no other factor on which I can put blame on. So ये problem आती है. But I think with education, with more popularity, with more funds like us coming to the market, more people investing in these kind of products, I think it will become easier for people as well.
Sir, thank you for pointing out what should be the right temperament for an investor who is investing into a global trading firm such as yours or a fund such as yours, especially during these times of drawdown or periods of underperformance. What is the psyche on the other side? What is your firm's approach? Is there any firefighting that you do? Is there any review that you do? Or is it just a part of business, a cycle that you allow it to pass through?
See, as you mentioned before as well, right? For us, everything that we try to do, we try to make sure that machines are taking most of the decisions, and we as a human are just putting all intelligence in the machine only, right? Even in these kind of scenarios, right? Whatever we learned in the past and whatever we are observing currently, we try to put our learning in the machine and let machine highlight what might be the problem. So let me give you an example. See, let's say if I'm trading in a number of markets, right? And every strategy has, for some reason, lost very small amount of money, but they lost it together. And it was a very, very small per strategy amount, right? It's like it's not even 1% of the risk that strategy is taking. But for some reason, it all happened together, and the round happened. Right? In these scenarios, we typically don't overreact. We let machine run as it is, because what we believe that too much manual intervention over the top of machine hardly adds value. But now let's say in another scenarios, let's say something structurally changed. Let's say in India, some months back, they increased the STT, right? Stamped STT tax on futures market, right? We used to do a lot of stock futures intraday models. And suddenly some of the high churn models in which we used to trade multiple times in a day, their performance started deteriorating. Why? Because of increase in STT, the bid-ask spread got widened, so our slippages increased, our cost doubled, right? So in these kind of scenarios, when we see the drawdowns are coming for some structural changes, or if we believe drawdowns are happening because certain changes happen in that market for long term, right? That's where we try to change things. We've taken a stance at that moment only that will focus more on durations in Indian stock futures. We will not stop playing Indian stock futures, well, but we'll play more duration. We'll reduce the allocation to stocks future strategies which are lower duration, and we'll increase to the higher durations. So these are the things that sometimes manually we have to put into the system when we believe there's a structural change. We don't want machine to take n number of days or n number of months to learn it, because, and this is one more thing that I want to add here, right? And it's good that you pointed out, right? One thing that we have observed, right, with one change that has happened in the market a lot is the markets change their cycle too fast. There was a time when market was a slow moving beast. Now it's a very fast moving, still a beast. It was always a beast, still a beast, but it's become from a slow moving beast to a very fast moving beast because of all kind of technology, all kinds of data availability, all kinds of information disseminations. People react very fast, news travel very fast. So now what you have learned, right? Everything has to go to the adaptive. So every strategy, obviously most of our strategies learn automatically. They try to learn their parameters dynamically as per the market environment. But this adaptiveness of our strategies, the investment, the research behind them have gone multiple fold from our side. That everything that we are doing need to be a lot more agile, need to be a lot more adaptive, because we know the market cycles are changing too fast, the rules are changing too fast, the market structures are changing too fast. Give you another example. China recently made a rule where they just say no collocation. It's just removed collocation.
Oh,
Right? So now and I think, just give you another example, the structural changes, right? Something you've never heard of in your life. Not in 2025, dollar depreciated 10 to 11% in the year. The dollar itself depreciated against all major currency 10-11% in a year, but still USD-INR had a worst year. So our INR further depreciated against a depreciating currency by another 5%. Right? These are the things are unheard of, where dollar is depreciating and still INR is depreciating. These are the things that never happen in the market. So markets now changes their structure very fast. Things which never used to happen will happen in months now. So even if we become hyper vigilant as an individuals and try to put all the learnings manually in these machines, it will never happen. So now a lot of focus have gone from our side into making our machines more agile, more adaptive. Strategies which were a lot more static in nature, we are slowly moving them out of our production systems and taking back to the back testing and make them more agile and more adaptive, because that's the only way to solve it. Only way to solve and figure out to best see that, okay, this drawdown is avoidable, or this drawdown we should react in certain way, is machine doing it. Put any human intervention in avoiding drawdown or overreacting during a drawdown will always have a negative consequence. So for us, everything boils down to how to make machine more intelligent, how to make sure that most of our, or almost all our decisions are coming from machine.
okay. So the key takeaway for our clients/investors is that markets are changing rapidly, and the way global quant trading firms such as 26 Miles Capital are working continuously to make their mathematical models more adaptive to these changes with very, very less human intervention. Sir, in terms of scalability, how scalable is the fund or the strategy as a whole? Is it that beyond a certain point of AUM, would there be any constraints? Any comments on these?
We are miles away from that. Miles, and our company name is 26 Miles, but probably in terms of max, we'll be 1,000 miles away from that. See, what has happened in the market, if you see that way, right? 2008 happened, and 2008 created a lot of depression in the market. Follow up, a lot of quantitative easing happened, which in a layman terms means a lot of money printing happened across the world, across countries. And eventually all this liquidity will find its way to markets. So if you see today, on an average daily volume in top 20, 30 exchanges of the world is in $1 trillion. The liquidity happening, I'm not talking about AUM, I'm talking about daily traded liquidity is in more than $1 trillion. More than $1 trillion. So if even I am, let's say, running a $100 billion fund, a $100 billion fund will typically trade what 500 billion, 400 billion in a day. Then also I'll not be even 3-4% of total volume happening in the world. At 2 days, market will explode from here further. So this crazy liquidity, crazy volumes happening in the market. There are firms who are participating at a crazy volume. I know firms who do 200 billion, $300 billion volume every day today. So I don't think the limit is something that we're thinking right now.
Okay.
Because we are far away from that, far away from that. For us right now, the only focus is to improve our product, to add exchanges, to make our communication more easy from our investment perspective, from our perspective as well. Because if it's become aligned for both us and investor, we believe this is a long-term journey that we will do with our investors. And I think size-wise, there's no limit here. There's no limit here.
Great. So I think the key takeaway for our clients/investors is that they can certainly look at 26 Miles Capital as their long-term asset management partner on the global quant trading side or for the next 20 years or more. Sir, a follow-on question is on your vision. What is your vision for 26 Miles Capital over the next 3 to 5 years, and if there is any long-term vision that you've thought of?
See, for us, it's, if you ask me, as I told you, right, we started the company without vision, right? We never thought that we'll do. Our thought process was very simple. Like, we love what we do and we'll keep doing what we are doing and just have good talent, keep investing on the technology. That's where we wanted to build a firm. It was a lot internalized vision than like kind of a granddaddy statement. But now as we are growing and as we are meeting more investors and as we are consuming what kind of offerings are out there in the market that other players are offering to the players, right? So we feel, right, as a firm that we want to offer a lot more products to our Indian people as well. I think right now we are managing very small, minuscule percentage from our Indian investors, and we really want to scale that. We want to launch AIF in India as well. We are only running an AIF in GIFT City. We want to launch an AIF in India as well. We want to make sure that we some kind of productize or algo trading product so that we can offer it to a level below HNIs as well. So there are a lot of things that we are trying to think in terms of making this product more accessible to a wider audience, because I think that will give us more pleasure, because in a way top 0.5% of the world, in a way they already have access to a lot of these products. Do they invest with us? But they have opportunity to invest elsewhere as well, right? So it's not like we are making a big difference to them, but we want to make a difference to the other people where we still believe that the education is missing or the access is missing, and we want to solve for both. Still in our early journey, we want to just make sure that we keep improving our product, keep making it sharper and sharper, consistent, and offer it to a much wider audience in India.
Thank you so much, Ajay ji. Thank you for giving us this deep dive on how a global quantitative trading firm works, how does a global quant fund works. I think it's been a pleasure to understand how does talent and technology combine to deliver a higher Sharpe ratio product such as yours. And to our clients/investors, the key takeaway would be to consider one serious allocation to a quant fund such as 26 Miles Capital from your overall wealth as high as 35% is what one should consider over a period of time. Second, what this allocation will do is it will generate uncorrelated returns to you, where the mandate of the asset manager is to generate absolute returns. When I say absolute returns, essentially returns agnostic of market conditions. And finally, go for superior products through such asset managers where the risk that you are taking for every rupee of reward that you make is much lesser than what you are currently experiencing in conventional ways of investing, such as long only. Thank you for viewing this, and do reach out to us at Equity Math in case you find this interesting and want to onboard with 26 Miles Capital into their global quant trading fund. Thank you so much.